the construction industry and the housing sector are facing an unprecedented crisis. Companies go bust.
Blood in the streets.
Jobs are lost.
Blood in the streets.
House prices are bleeding.
Blood in the streets.
Is this the start of a new Luxembourg order? Will bears dominate the country? What is happening? Hey everyone, my name is Angelo and this is Two Hats. Welcome back. If you invested in the Luxembourgish real estate, you are a potential buyer or a potential seller. I'm sure you read countless articles about this topic in the past few months. For those of you who don't know me, I've been working in Luxembourg as a construction project manager for the last 9 years, and I've been living here since I was a kid. Before we dive in, consider subscribing to this channel and leave a like. If you're interested in personal finance topics in relation also with the real estate market, this is exactly what I'm planning to do in this channel. This video will have 3 main sections. 1, current market condition. We look at stats and trends. 2, we try to identify the main reasons that are affecting this market. And 3, what is the government doing to counteract this trend? And finally, I will share my opinion on the topic and of course, feel free to share yours in the comments. So let's start. What is the current market condition? In order to understand it, we need to look at statistics. From Statec, the national statistics portal, the report was published in September 24. We don't have more recent statistics than this. Let's look at the first graph. The graph represents annual variation of price. So you can see here that the end of 2022 was the top of the market bubble. Let's call it like that. The general index has diminished of 8.3%. Existing houses suffered the most. New apartments sold during the construction, this is called VFA, suffered the least. For you who don't know VFA, it means Vente en futur état d'achèvement, an apartment which is under construction. You are buying the apartment while it's being built. If you look in a shorter time frame, we can see that the market bounced and seems getting better. Speaking of transactions, let's go on the second graph. Transactions represents the activity on the market, an indicator to measure how dynamic and liquid the market is. Here is what we see: an increased activity on the second semester 24 compared to the same period last year. Regarding apartments, plus 22.4, we have an overall of 1,065 sales, the highest number of transactions since 2023. But still not at the average number of transactions of the period 2017-2022. On the financial volume side, we have a slightly lower increase, plus 13.8%, highlighting a decline in average sale price. We see here that there is a huge difference between the existing apartments and the new build. Let's go on the house side. Existing houses plus 33.8%, 570 sales total, below the average number of transactions on the same period 2017 and 2022. On the financial volume side, the increase is slightly lower, plus 25.3, highlighting the same conclusions of price declines during the year. After that, we can look at building lands. We see an activity that suffers a bit more and recovers slowly, minus 6% compared to the second trimester of last year. 235 transactions, greatly below the average number of transactions of this period, 2017-2022. On the financial volume side, we have plus 82.9%. Average price of land almost doubled. Is it really the case? Probably not. Price of land is influenced by localization, surface, construction density. Here there is some inconsistency of the data. It's more correct to say that these sold lands were in the most expensive areas of the country, thus leading to this strange data. Okay, if you're still here after all this data, congratulations. Let's make a quick recap. So first, price. Existing houses suffer the most, followed by existing apartments and VEFA apartments. Why is that? My guess is that apartments in construction are usually sold by contractors, promoters, or big investors who have running costs, construction costs, thus are trying to keep the selling price higher. They are basically different actors compared to the existing property market in which anyone can participate. Regarding houses, since they had a higher average selling price, those were the most difficult to sell, hence the biggest price correction. In terms of liquidity, existing apartments are leading the market. Why is that? In times of uncertainty, the already built seems to be the way to go. Existing apartments offer some sort of flexibility. They are ready to live in. In average, also selling prices are lower. Finally, building lands volume reflect the uncertainty and the financial struggle on the supply side. So we have promoters and contractors that are not buying land to develop new property. And this is a huge problem because in the moment of recovery of the market, when demand shows up, we will likely experience a supply shock. Less properties on the market, a lot of demand, likely a new spike in prices. First and foremost, access to the real estate market has been negatively impacted by economic factors. One above all, rising interest rates. If we look at the graphs, the correlation here is quite obvious. As interest rates rose, prices and demand on the housing market went down. We can make a quick example on the spreadsheet so we'll understand a bit the dynamic. In this table, we are interested in finding out the monthly repayment based on a fixed interest rate. Google Sheet already gives us a formula for that. We will take into account a loan of 800,000 euros, roughly a flat of 80 square meters in Luxembourg. Length of the loan 30 years, a fixed interest rate of let's say 4%. On household infos, the net income of the household, let's say 8,000 euros, and here we allow a max debt of 45% of the net income. Banks usually have this condition. You can see that 800,000 euros at a fixed interest rate of 4% will require 3,819 euros per month, higher than what we are allowed. Loan feasibility, no. Let's try 2%, roughly 3,000 euros. It's a yes. Here I prepared a second sheet. You can see with increasing interest rates, you have the monthly payments. Very simple. Now add to this, banks increased the cash deposit necessary to giving you a mortgage. The salaries did not increase as the cost of life. An explosive cocktail for market capitulation. Another important topic is competitivity. According to the World Competitiveness Center, yes, Luxembourg is losing its ground, positioning itself 23rd in 2024 and confirming a descending downtrend that basically started in 2020. Also, the construction sector and the real estate market are mentioned as big challenges in 2024. What to take from this? In my opinion, in this precise historic moment, for someone in his 30s, Luxembourg might not be the first option. On equal conditions and maybe a slightly lower salary, many might decide to go in a bigger city that offers more opportunities, or in a country with better climate conditions. It might seem unreasonable, but climate for many it's a huge factor. On the other hand, we also need to talk about companies, international companies. Is Luxembourg still attractive to these companies? I think A lot more has to be done on this side to maintain its attractivity. The main problem, salaries. Very high in Luxembourg compared to the rest of Europe. We have indexation. There is a concrete risk of relocation. Finally, apart this recent crisis, Luxembourg is facing in the last 20 years a shortage of production of housing, a structural imbalance between demand and supply. It's a systemic issue that most probably contributed to the bubble burst and also to the vulnerability of the sector. Now, let's go and see what has been done by the government to counteract this trend. In May, la Chambre des députés voted new measures, reinforcement of the VEFA acquisition program, so 800 units should be bought in the period 2024-2027. Keep a high level of investment for public affordable housing. Economic helps for individuals and families were increased, and also eligibility criteria were widened. Subventions for rents, subventions on interest rates were increased. The tax credit, also called the Billigen Act, increased from 30,000 euros per person to 40,000 euros per person for all notarial deeds signed in 2024. Finally, recently announced in October, the reduction of tax registration when buying property from 7% to 3.5%. If we take the example of before, for a flat of 800,000 euros, we would have 28,000 of money saved. Will this be enough? I don't know, but what's my take for the future? This is just my personal opinion, and it's biased. I work in the construction industry and personally invested into the real estate sector. My take is that the market is slowly recovering, and the trend we saw on the statistics will likely continue. I feel the market has been quite shy, always waiting for the next fiscal measure or the next interest rate cut. There are new projects showing up. On the other hand, I know for a fact that many companies are struggling and many companies have financial problems. We will see how things will play out. Finally, from a price perspective, I feel the gap between demand and supply has been shortened. Interest rates going a bit lower, prices stabilizing on the lower side, dust is settling down, and hopefully supply and demand can match. What about you? Do you plan to take action? Feel free to share your views on the complexity of the market in Luxembourg in the comments. My name is Angelo, this is Two Hats, I'll see you in the next video.